The U.S. stock market is kicking off 2026 at dizzying heights, with investors and analysts alike marveling at the remarkable run-up in equities over the past year. The energy on Wall Street is palpable, as traders and financial professionals keep a close eye on every tick of the market, wondering just how high this rally can go. The S&P 500, the benchmark for U.S. stocks, is flirting with all-time records, inching closer to levels that seemed out of reach just a few months ago. Headlines across financial media are buzzing with excitement, and the mood is one of cautious celebration. After a stellar 2025, which saw the index surge on the back of strong earnings and resilient economic growth, investors are now asking the big question: can this momentum last? Or are we nearing the top of the mountain? The optimism is real, but so is the uncertainty. Despite some volatility along the way, the market keeps bouncing back, showing deep confidence in American companies and their ability to weather economic storms. Each time the market has stumbled, it has quickly found its footing, with buyers stepping in to scoop up shares at every dip. Each dip has been met with renewed buying, as optimism outweighs short-term jitters. Investors seem willing to look past temporary setbacks, focusing instead on the bigger picture of long-term growth and innovation. But with stocks hovering near their peak, the next move could set the tone for the entire year ahead. Will the market break through to new highs, or will it finally pause for a much-anticipated correction? Wall Street is cautiously optimistic, but many are bracing for a possible correction. Some analysts warn that valuations are stretched, while others point to strong fundamentals as a reason for continued gains. The debate is heating up. Is this the start of a new era for stocks, or are we due for a reality check? Market veterans recall past cycles where euphoria gave way to sudden pullbacks, reminding everyone that risk is never far away. The rally is fueled by expectations of strong corporate performance, not just hope. Companies are posting impressive earnings, and many are raising their forecasts for the year ahead. Investors are betting on continued innovation and profit growth, ignoring political noise for now. The focus remains on fundamentals, revenue, profits, and the ability to adapt in a changing world. This faith in U.S. companies is the main pillar holding up the market. From tech giants to industrial leaders, the belief is that American business can keep delivering, no matter the challenges. The coming weeks will test whether this confidence is justified, or if the high-wire act is about to get shaky. Investors are preparing for anything, knowing that markets can turn quickly. All eyes are on what happens next, as the S&P 500 stands at a crossroads, and the world waits to see which way the market will move. With stocks near record highs, all attention turns to corporate earnings. This is the moment when companies reveal if their profits justify soaring share prices. Strong results could fuel the rally. Weak numbers might burst the bubble. Investors and analysts are laser-focused on these reports, which cut through political and global distractions. Solid earnings are the foundation for continued optimism. If companies deliver, it signals the U.S. economy remains a solid bet. If not, confidence could unravel fast. The drama of earnings season is about to unfold, and the stakes couldn't be higher. The numbers will tell the real story. Earnings season began with major banks like JPMorgan and Wells Fargo, but their results set a cautious tone. Despite solid profits, their stocks pulled back. Investors saw warning signs in the details. Banks are economic bellwethers. Their guarded outlook hints at possible challenges ahead. Higher loan loss provisions and muted forecasts have made Wall Street nervous. This early reality check has tempered some of the market's optimism. The big question, is this just a banking blip or a sign of broader trouble? Other sectors now face pressure to deliver blockbuster results. With the major banks having already reported their earnings, the spotlight now shifts to some of the most influential players in the tech and healthcare sectors. These industries are not only vital to the economy, but they also shape the way we live, work, and stay healthy. Investors and analysts are eagerly awaiting updates from these giants, as their performance often sets the tone for the broader market. This week, Netflix, Johnson & Johnson, and Intel are set to report their latest quarterly results. Each company offers a unique perspective on the state of the economy, spanning entertainment, healthcare, and technology. Their earnings will provide valuable clues about consumer habits, business investment, and the overall health of key industries. For Netflix, all eyes are on whether its subscriber growth and revenue can support ambitious strategies, such as its high-profile bid for Warner Bros. The results will also indicate if consumers are still willing to spend on streaming, even as competition intensifies and economic uncertainty lingers. Johnson & Johnson's earnings will be closely watched for signs of strength or weakness in both consumer health products and the broader medical industry. Their performance can reveal how much people are spending on everyday essentials and advanced medical treatments, offering a window into both household budgets and healthcare trends. Intel's report will be a key indicator of business confidence in technology. If companies are investing in new computers and data centers, it could signal optimism about future growth. On the other hand, a slowdown might suggest that businesses are tightening their budgets amid economic headwinds. The earnings from these three companies will send ripples through their respective industries and the broader stock market. Their results can influence everything from investor sentiment to the direction of major stock indexes. If the numbers are strong, it could boost confidence in the resilience of tech and healthcare, encouraging more investment and potentially driving markets higher. But if there are signs of weakness, such as slowing sales or cautious outlooks, it could raise red flags about consumer and business spending and spark concerns about the pace of economic recovery. Ultimately, the combined reports from Netflix, Johnson & Johnson, and Intel will help define the market's direction in the weeks ahead. Investors everywhere are watching closely, ready to react to every headline and number. Despite some caution, analysts expect a strong year for corporate America. S&P 500 earnings are forecast to jump 15% or more, with growth across all major sectors. This broad optimism is the backbone of today's high stock prices. Investors believe robust profit growth will outweigh political and global worries. But these are just forecasts. Surprises could derail the story. That's why this earnings season is so critical. Companies must prove they can deliver on high expectations. The market is priced for perfection. Now it's time to see if reality matches the hype. The data will decide. Policy proposals from President Trump are adding new uncertainty to the market. A proposed 10% cap on credit card interest rates threatens bank profits. Plans to block Wall Street from buying single-family homes could disrupt real estate. Investors now must weigh political risks alongside earnings. Every new headline or tweet can jolt the market. The challenge, separating political theater from real policy threats. For now, strong fundamentals are winning out. But that could change fast. Policy noise is a growing headwind. The independence of the Federal Reserve is under scrutiny. Legal battles over Fed leadership and a criminal probe into Chair Jerome Powell have shaken confidence. The Supreme Court is also weighing the fate of Trump's global tariffs, adding to the uncertainty. If the Fed is seen as politicized, market volatility could spike. The central bank's credibility is crucial for economic stability. Investors are watching Washington closely, knowing the Fed's future could impact everything. Trade policy decisions could trigger major market moves. The Fed's role as a steady hand is now in question. The stakes for the financial system are enormous. Geopolitical risks, especially with Iran, are rising. Tensions in the Middle East have captured the world's attention, with headlines warning of potential conflict and uncertainty. The region's volatility has historically sent shockwaves through global markets, and investors are watching closely for any signs of escalation that could disrupt the delicate balance. Yet, Despite these looming threats, the U.S. stock market remains remarkably unfazed. Wall Street continues to hum with activity, and major indices like the S&P 500 keep pushing higher, seemingly immune to the noise from abroad. Gold prices are up as some investors seek safety, but stocks keep climbing. This divergence highlights a fascinating split in investor psychology. While some are hedging against risk, others are doubling down on equities. This resilience shows investors are focused on strong domestic fundamentals, not global threats. Robust corporate earnings, steady economic growth, and consumer confidence are fueling optimism, even as uncertainty swirls overseas. The market's Teflon quality has helped it reach new highs. Investors seem to believe that the U.S. economy can weather almost any storm, brushing off bad news and celebrating positive data. But history warns that geopolitical shocks can hit suddenly. Past crises have shown that markets can turn on a dime, and complacency can be costly. If tensions escalate into conflict, the impact could be swift and severe, affecting everything from oil prices to global supply chains. The market's calm could vanish overnight, replaced by sharp volatility and sudden losses. For now, investors are betting on earnings, not fearing headlines. The balance is delicate. Confidence can quickly give way to caution if the news turns grim. One major event could change everything, sending shockwaves through markets and upending the current sense of stability. The market is walking a fine line between optimism and risk, with every new headline carrying the potential to tip the scales. Gold's rise is a warning sign, a reminder that not all investors are convinced the calm will last. Even if stocks ignore it, the growing demand for safe havens suggests underlying anxiety. The calm may not last, and the next headline could be the one that finally tests the market's resilience. The road ahead is filled with both promise and peril. The biggest test: can companies deliver the profits investors expect? Disappointing earnings or cautious outlooks could trigger a sharp correction. Political risks, from credit card caps to Fed drama, add new layers of uncertainty. Global shocks like Middle East conflict or trade disputes could quickly derail the rally. Investors must stay alert for surprises from Washington and abroad. The market's record run depends on earnings winning out over noise. One negative shock could shift the narrative from growth to risk. The challenge: focus on what matters and don't get lost in the fog. The next few weeks will be decisive for 2026's market story.